Job growth in the U.S. is steadily rising as cities fully reopen and more Americans get inoculated against the coronavirus. The Labor Department's latest report, shows the country added 850,000 jobs last month, but unemployment rose to 5.9%. A disappointing spike after jobs numbers released in May indicated the economy was gaining some momentum, with unemployment coming in at 5.8%. With more on these numbers, let's bring in Barclays chief U.S. economist Michael Gapen. Michael, always great to have you on. Help us make sense of last month's numbers. What do they indicate to you about the state of the U.S. economy?
I think it certainly is a signal. First of all, thank you for having me on, and happy 4th of July weekend. I think it's a signal that the economy is reopening, that things are certainly getting better, that the labor market is healthy. Most of the job growth came in leisure and hospitality sectors, and restaurants, and bars, and travel-oriented retail trade. So these are all the sectors that were, of course, most heavily affected by the pandemic. They're coming back to life. So I think it's a sign of economic momentum. I would call it a healthy report, not a blowout report. There are still issues with how the economy is reopening. There's frictions that are at play. Some of those frictions are boosting prices. It's just making it harder to get like a blowout employment number where we might be adding 1 to 2 million jobs a month. But I think the economy is going in the right direction, and I think overall this was a healthy report.
So you call it a healthy report, but does it shape up to what economists were expecting?
I think on net it does. Look, I think the number at the headline, 850,000, was more than most of us were expecting. But what's also in that number is what I think is some noise around some of the education data. Normally at this time of the year, at the end of the school year, you would see a lot of layoffs in the education sector as we move into the summer. And so the seasonal factors actually try to boost employment there. And so we had about 155,000 in local education hiring, another 75,000 in state education hiring. That's probably distorted. The pandemic is giving us very unusual hiring patterns, and when we map that against the normal seasonal patterns, I think there's noise there. So what I would do actually is look at that 662,000 gain in private employment. I think that's where the real signal is, and that was pretty much in line with what we were expecting. Economists have been saying it's going to take 12 to 24 months for the labor market to fully heal itself, for all of this to kind of work itself out. We're not thinking you're going to add 2 to 3 million jobs in any given month. We're thinking it's going to take time. 662,000 to me is a healthy number. And again, that's where I would take my signal.
There's one interesting thing that's happening right now, Michael. I want to get your take on it. Jobs openings are at record levels, but employers report having a difficult time filling those postings. Why is that?
So I would say that there's likely a number of factors. One, I think the most important in my mind is still likely the idea that infection risk remains high. We're doing a good job in vaccinations. A large number, over 65% of the adult population has at least one shot. But that still means there's a lot of unvaccinated people out there. There are more transmissible variants, as your previous segment had discussed. So I think some people are worried about going back to face-to-face employment while we just quite don't have full control of the pandemic at this point. We're getting there, but we need a little more progress. I think that's the most important issue. The second could be federal unemployment benefits that are making it a little easier to stay out of the labor force for a few more months. I don't think that's a permanent story. I just think it may make people a little more selective over the course of the summer. And so these are causing frictions, and I think it doesn't mean that the labor market isn't doing well. I just think it means it's going to take longer for a match to occur. And I think finally, daycare centers aren't open fully, and I do think that there are childcare constraints which may be preventing one or both parents from coming back into the workforce. Again, we think this will work out over time. It's creating a weird situation where we have record job postings, in terms of openings, as you mentioned, and not you'd think you would be getting more employment on the other side. So it's creating a bit of a tension in the data.
So you cite COVID concerns, unemployment benefits, and childcare concerns. What about the possibility of people holding out for jobs aligned within their expertise and industry experience? How does that impact the road to economic recovery?
Yeah, so I think what's hard to, you make a very good point. I think what's hard to also ascertain here is, do people have a different view of the job that they want to hold post-pandemic versus pre-pandemic? Is it a different industry? Is it that job postings are coming in the services sector and I don't want that employment anymore, or I didn't have it before? And am I getting the right work from home, work in the office balance that I want? So it may make people a little more selective about saying, I had that job before, I don't want it now, I want to do something different. And it means employers may have to respond. Is it a wage issue? Do we need to pay people more to get them in the front door? Is it a reservation wage? Or do we need to restructure roles in a way that are more appealing to people? So again, it'll take time. But if that demand for labor is there and firms need it, I think they'll find a way to get that labor in the door.
Obviously, one of the cornerstones of the White House's agenda is economic recovery. How much credit does the White House deserve for these numbers?
Well, look, I think that the most important driver of the recovery in the economy and the labor market is controlling the pandemic. So I would say I think actually both administrations deserve credit in that regard for getting vaccinations in play, and then for getting it distributed throughout the country. So I think the focus on, once vaccines became available and they got quick approval through the government, they were obviously supported by government funding as well and fast track. And then I think the Biden administration did an excellent job in terms of prioritizing getting vaccinations out to the public. That has meant, as you know and have been reporting, case counts are coming down, hospitalizations are lower, deaths are lower. It's not a done deal. We're not on the other side, but I think that has been the number one most important factor driving both the U.S. economy and the global economy.
And so we've dissected these numbers a little bit. I want to change gears slightly. As the White House continues to work with Congress on its bipartisan infrastructure framework, explain the economic impact a deal like that could have on the U.S. economy once it's implemented.
Yeah, so these would be very large numbers. So the numbers, as you know, are quite large, somewhere between $1 to $2 trillion, and in some cases the ask could be as large as, say, $4 trillion. These are numbers typically spread out over 10 years' time. So a few $100 billion a year in additional spending. These types of spending programs, particularly what we call the hard or surface infrastructure plans, they take several years to ramp up. Again, there's often this phrase shovel-ready projects, but it really takes about 4 to 5 years for these types of programs to ramp up. What that means is you could get incremental support for the U.S. economy. These types of spending bills could add maybe 0.5% to 1% on the rate of economic growth over the next, say, 2 to 3 years. And keep demand in the economy strong, support further improvement in labor markets. And they could have very important long-term benefits. Economists often talk about potential growth in the economy. And these infrastructure packages tend to improve efficiency and raise potential growth. So it would have both what we call a cyclical improvement. It would create likely a faster recovery, but I think it also improves how fast the economy can grow on average over time. So it could have very important impacts both on what we call the cycle as well as longer term trends.
Michael Gapen, I am no economist, but all I hear is improvement. That's a great thing. Thank you very much. Great to have you on.
Thank you.